All right, hey, good morning, everyone. It is 9:24 here on Wednesday morning, and I just wanted to do a quick live update for you so you can see exactly what it is that we're looking at. So on the screen I've got in front of you, I've got corn, daily March corn right here. This is the 240-minute chart of March corn, and this is the 60-minute chart of March corn. Now we've come a long way really fast, right? We've been straight down for 1, 2, 3, 4, 5, 6 days basically. And this is the kind of move that you would expect after a consolidation period like this fails to hold. And there are some things fundamentally that are driving it. And I think the largest one is the just the lack of exports. The lack of interest in our crops is pretty significant. You know, if I pull up the USDA website here and show you when the last reportable sales were, it was February 17th when we sold 120,000 tons of corn to China. You know, before that we had sales pretty much every day, and we're just not seeing the demand that we'd like to have. So corn is finally starting to price that in. Now you've got some other things happening too that could be bullish, could be bearish. You've got Ukraine moving supply that could be bearish. It could already be priced in. I don't know. You've got the safrinha crop being planted, and if that crop goes in after March 1, that's equivalent to planting in July, so that could be supportive. So the market is pricing all of those things in, and we're just heading lower. So we're in a liquidation phase, right? But the question is when will we bounce? Because we know markets don't go in straight lines. And what they can do is they can correct an oversold condition in two ways. They can trend up, or they could do a counter trend move back to the upside, or they can just move sideways. And my expectation personally here is that we're just going to move sideways. I don't think that we're going to get a big bounce. But if we do get a bounce, that will likely come from one of these two places in our opinion. And this is drawn off of an extension from this high right here. And what this is counting is the distance from this low um, to this high, and this is measuring an extension of it. So if you just take it times 1.382, which is from here to here, times 1.382, the distance counts down to 617. So we could see some buying right in here. It may go ahead and move on lower. It's not out of the question, though, that this thing accelerates to the downside and comes all the way down to this level down here at 580. And the reason I think that it could do that is a couple of things. One, it's the strength of this move. This is pretty powerful. So you've got the funds that are long, and now they're being forced to liquidate. You've got the end user who's just going to sit on their hands. You know, they're going to welcome lower prices. You've got the farmer who is caught long and undersold. So the farmer's got to sell, the funds have to sell, and there's really not a natural buyer in the market to step in and take it from them. Now, at some point, buyers will emerge and selling will run out, but I don't see that as of yet. You know, if I perspective is everything. So if I put this chart back to this level, you see how oversold the MACD is. I mean, it just looks way deep and oversold, right? Same thing with stochastics, and RSI looks oversold. But if I kick this back out, it's much less so, right? In fact, you can see the last time we were this oversold in stochastics was at the end of this move. We did get a little bit of a rally, and then we came right on back down. This was a nice divergence, and that triggered the onset of this rally, which also left this gap down here at the bottom, which was a breakaway gap. That's another reason I think that we could naturally trade down into this level and maybe even lower, because corn loves to fill its gaps. And so a lot of algorithms may view this as a buy zone right down in here, which now is in play. It's only 20 cents away. Now, this doesn't change the fact that we're longer term bears, okay? we think that the carryout in corn is growing, but I don't think that means we need to implode corn all the way to the graveyard just yet. I think I think that a sideways to lower trade is probably practical, especially in the later contracts. You know, we don't have the same set of issues back here that we have in the March or in the May contracts. So what we could end up with in December corn is just a sideways chop until the March 31 planting intentions report. I don't think we're going to rally this thing all the way back up. I think that's extremely unlikely, and it'll take some sort of a significant event, like really bad planting delays and a complete contraction of the safrinha crop. It'll take some sort of demand miracle that would put some premium back into this market. So for December corn, I really don't want to do anything yet. We might make a hedge adjustment if we get a little bit deeper, and I think the adjustment we'll make is we'll probably sell some puts and just try to put a little bit of time premium in our pocket if we rally back up. I don't want to lift farm hedges at this point because I think our downside is still too real. You know, if we do grow this carryout to 2 billion or whatever, then in the next few months we could easily take another $1 or more off of the corn crop. And I know nobody wants to hear that, but I don't want to get too cute trying to catch a 10 or 20 cent rally if that's what our risk is. I would rather sell a put and let some time decay creep out, or buy a call and kind of hedge it that way. I'd rather just hold my futures positions. Now in May, from a speculative standpoint, it's a little bit different. You know, these things are going to move pretty fast, and so you could you could be a little bit more aggressive down into these levels, but I don't think it's just to go, you know, cover your short position and buy and get naked long corn because we think it's going to rally. I don't think it's that. I think if you do anything, you bank some profit, or buy a call and try to hedge your futures, something to that effect. You just want to minimize your risk and not let a nice gain go. And even down into this area, you know, I think the market could chop sideways if it gets down to here, but it's going to take something significant to push us higher. Now, something that could fuel that is Kansas City wheat. Okay, Kansas City wheat is down. It's trying to test this $8 level, and so where might we want to lift a corn position? Okay, now follow my charts here. This is Kansas City wheat, May Kansas City wheat. These are our corn setup. You should never hedge your corn in the wheat pit, but you shouldn't ignore it either. So this $8 level into this extreme oversold condition in Kansas City wheat is pretty important. A break of this level could be either a stop running move, or it could honestly just accelerate itself lower and really pummel itself all the way down to a whole new trading range. So what I want to do with corn is I want to pivot off of this $8 level over here. If wheat holds $8 and starts to rally just a little bit, I think that that's going to stall corn out. So I would want to maybe exit my corn futures, or substitute a short corn future for a long put, or buy a call against it. I would want to do something to participate in or improve my position into a counter trend rally if wheat goes ahead and rallies. But on the other hand, if wheat dies and goes ahead and breaks this level and trades down into the 750, 730 level, and we'll know what it's going to do by how it breaks this level, then I think you just want to stay short, because corn's going to drop all the way down to this lower extension and fill that gap that's back on that chart. So we're to a point where we want to be aware of what's happening, but we don't want to get we don't want to just rush to the exits and exit a trend too soon, it's one of the hardest things to do in this business is understand when to modify and versus when to just hold your position. And I think this is telling us don't do anything yet. It's got more to go because there's nothing in this setup that's a bottoming signal. And really, we won't have any kind of confirmation of that until we trade back up above the 635 level. And this our chart is going to keep working itself lower until it gives us some sort of a bottoming indication. And I think if this breaks over here in wheat, then corn is going to go ahead and roll over with it as well. All right, now let's talk about soybeans because that's another thing that could really impact corn here too. So yesterday's low was 1477 and 3/4 in May soybeans. This low right here is 1476, and this low is 1472. Obviously, we've held that so far. This is a pretty steep move, and it's pretty impulsive. I would expect this low to give way either today or tomorrow and come challenge these lower levels. And if these break, then like wheat, I don't know why corn would trade higher. You know, if $8 is a good pivot on wheat, then maybe 1475, 72 is a good pivot on beans in relationship to corn. Because if beans break lower, what is going to keep corn up? You know, we're looking at growing a big corn crop and planting a lot of corn acres. And beans have been holding everything up because of their demand and their tightness. But if the corn margin is wide and acres are favoring corn and beans go ahead and collapse because the Brazilian crop is so high, then it's going to drag everything down with it. And it's a little counterintuitive because you would think that beans would be supported with corn having a better margin. But if we don't need them anyway, because Brazil's going to take our export business, then they may need to reset anyway, even though corn is more attractive. So corn doesn't need to get more acres, so it's got to go lower too. All that's going to be taking place in the new crop contracts, which tells me that we've got even more downside risk than maybe we thought that we had prior. So we're definitely bearish these grains. I don't see the bull side of things real clearly at this point. I just think they're so overwhelming to the downside. You got to stay hedged. And if these lower levels give way, then oh my gosh, you know, this thing could accelerate. You know, beans, this breaks, you know, we could be down here at 1418 in, you know, hours. I mean, it just won't take long at all for the selling to get overwhelmed here. And if we come down to the 61.8 retracement and don't hold 14, then you know, our next target is all the way down here at 1320. So beans could drop really far, really fast, and you could have this cascade, right? If wheat breaks, and then corn starts to break, and then beans break, this thing could catch a lot of people off guard, thinking that things are too oversold and we've got to go ahead and back and rally. Guys could get really caught off guard, and this thing can get absolutely pummeled if these levels break. Now, a little bit about trader psychology and why why that might be what's setting up. Sideways markets do a lot of psychological damage to traders. All of us want the market to move, and when it doesn't, and it just chops and slops and beats you to death, it exhausts you completely. And so if a trader was getting bearish down here in wheat or corn, take your pick, and getting beaten up on the short side, and then they rally it, then they turn bullish up here and try to revenge trade it. Now it's ripping your head off to the upside. You may try to revenge trade one more time. And if it rips your head off again, then you're just going to capitulate and you're just going to exit everything and say, I'm done. Remember, anybody that's bought, the long position started getting longer in corn back in December. Right? They didn't really get long through here. They weren't short, but they didn't really build their long position until they got into this area. And this whole time from December forward, they've been building a long position and unable to move prices higher. Now, anybody that's bought it since since the August trade time is now underwater on these positions, and they've just been beaten to a pulp on these sideways moves. And if they try to revenge trade this and it works lower, then they're going to have to exit, and they're going to get pummeled to the downside. So if the funds that trade corn decide that they want to shift to the short side of corn, then they are going to sell the equivalent of about 600,000 more contracts to put them in a 400,000 contract short position. And they won't do that overnight, but if that's the trend, then this thing's just going to get pummeled to levels that that we didn't think were going to be seen for a long time. Now, I'm not saying all that to scare you. I'm just trying to keep it in perspective of what is happening and why these moves are so short. Or so steep. You've got fundamentals that are bearish, you've got demand that's bearish, you've got traders that are caught off guard and wrong, and the funds are long and wrong anywhere that for anybody that's bought since August. And they're going to have to reevaluate that position. So a rally that sucks them back in probably ought to be sold because this is a really big, powerful move. So all of that rambling, all of that noise is really just summarized by saying we're going to be patient and we're going to wait and see what wheat does. We're going to wait and see what beans do before we rush in and make an adjustment to corn, because I think we could have another 30-35 cents to go before it does rally. And then on that rally, we could get a little bit of a bounce. Let's just pretend that this move, let's pretend it drops down to $6, okay? And it does so, and it just drops on down. Then a 38.2% retracement to 632 and a 61.8 is 650. So you could see a move back up into this area before it rolls over and sells again. And if it were to go ahead and bottom out right here, then your retracement level is, oh shoot, hold on. Your retracement level, take that one off, clean it up, counts from here. Your retracement level to 61.8 is 660. So you've got a 34-cent risk back to that level. And if we drop on down, the same risk is back to the 650 level. So I don't see any reason to make an adjustment yet. Even if it does trade back into here at the bottom of the range, I'd rather just hold my position and not overtrade it. I'd rather just stay in because I think it favors a lower move after that. And I've got a lot of reasons to say that too, but I'm getting long-winded and it's been 18 minutes here. So fundamentally, I don't see any reason, any compelling reason that we've got to bounce. If it does bounce, I think it's just because it's oversold. Otherwise, what was once support is now resistance. So corn's got a lot of work to get back up above the 640 level in our opinion, and otherwise we just want to be looking short for some sort of reversal signal on lower. All right, that's where we're at as of 9:43 on Wednesday morning. If anything changes, we will keep you posted and up to date. Monitor your texts and emails for updates, and monitor your Facebook page so that we can communicate quickly and rapidly to you if we need to make any adjustments. And we will talk to you later. Remember, there is risk trading commodity futures and options, and you should only do so in light of your own financial condition. If you need help or thinking through a position or understanding your risk, please call us, and we will be happy to walk you through what your exposure is. I hope you guys have a great day. We'll talk to you later on.